Let me just say a few things. I'm Kevin O'Reilly. I'm based in London. I run our financial services business in Europe. That's a euro over there. Feast your eyes on it while you can. It may not last that long. Okay. First of all, more interestingly, I'm one of the co-founders of our Center for Regulatory Strategy. That's a group that we set up about a year ago in Deloitte to try and look at, not so much, we had a lot of people who looked at how to interpret regs, how to know what the next regulation was. We didn't have a lot of people who knew how to help clients figure out what to do about it. So we set up a group called Regulatory Strategy, and some of the ideas I'll present to you today have come out of our Center for Regulatory Strategy. So first, 4 themes. The first one is, if I leave you with 4 thoughts, the first one is regulation on steroids, right? So if you think about it, over the past few years, I guess regulation is a bit of a reflection of the way business models have come under pressure in the economic cycle. But business models also drive regulation and vice versa. So it's a bit of a cause and effect. How much is regulation, how much is the reaction? But let's just deal with regulation today then as the driver. We've seen 80 years of evolution in about 3 years. So since the Great Depression in the US, there hasn't been as much regulation in that whole time period between then and 2008 as there has been in the 3 years since. So we've seen an accelerated cycle. So really, this talk is really about evolution and dinosaurs, and I'll bring up some of those themes later. But in an accelerated cycle, you tend to see phenomena that otherwise would take a long time to see in a very short period of time. So regulation in banking, why is it so interesting? It's not simply because there's a lot of regulation. It's that the implications are profound because it changes traditional measures of success and makes them that now they look incompatible with the new regulatory requirements. So I'll show you some quotes on a slide that sort of bring this out. I mean, businesses are subject to a degree of pressure, and they have to embrace sort of challenges and clarity about what's their new purpose in life. Financial institutions have been asked questions like, what's your social value of financial services, right? Are you there to fuel growth? What's your purpose? And that has been really helpful because it made people start to reevaluate what the true nature and start to go back and question financial services. For banks, they're likely to involve more of a long-term view and value creation as a result. In the past, we saw ROEs, return on equity, in around 15%. That's probably not realistic anymore. We're probably looking at the 5 to 7 range now. And because of that, previous ROE targets were too high. We have to really think about what is a sustainable profitability for a financial institution, as well as what does the through-the-cycle profitability picture look like, and what does real growth look like. Right? We need new metrics for this new world. Sustainability also requires banks to pay more attention to the cost of their funding, look at liquidity metrics. We're going to talk a little bit about data later, like stable funding ratios and loan-to-deposit ratios in the new world. So really, we see 3 elements to the strategic change in the marketplace. The first one is getting on the front foot with regulators by building more of an open architecture, and I'll talk a little bit more about what that means before. But suffice it to say that regulation has been seen to date as something that you sort of defended against. You spend as little time as possible. You sort of closed ranks around how much information you had to give to a regulator, and you sort of fought them off and fought the long battle and tried to get away with what you could. The second is the changing organization structures and capabilities that are going to be needed to meet these new imperatives. And I guess because our organizations have to change. And I guess the third is adjusting propositions to drive customer value in new ways. The value proposition for financial institutions has changed. I'm going to talk a lot about banks, but that's probably because the insurance sector hasn't been through as profound a change yet, but that'll come. Anyway, the main message is we can't go back. So first, a little bit about the second point, the open architecture. What is the open architecture? Well, if you think about how insular and defending the proposition has been in the past, I guess the difference really is this sort of sustained dialogue that institutions have to have with their regulators, their stakeholders, other financial institutions, the government, and investors. In the past, a sustainable strategy to secure the active support of governments and regulators and to ensure that key suppliers of banks' funding, investors, and depositors support prudent bank activities. Fairness is a two-way street. Secondly, markets have short memories. Right? The nature of cyclical industries is that at high points in the cycle, there are players who will compete by talking about a new normal and profit over the short term at the expense of taking on hidden or disputed risks. there is a large pool of short-term investors that will support banks and put pressure on the management versus their more conservative peers. Reward awaits those who get this right, but investors have a role to play also. Moreover, in banking, where products are largely commodities, players that do not move their pricing and risk appetite into line with a competitive environment risk losing their customer franchise, as we'll talk about later. And this was always there's always been a great disincentive for bank management to reduce their risk exposure during the peak of the boom. The new rules make it difficult for players under the same regime to repeat the mistakes of the past, but regulatory arbitrage from both cross-border and cross-industry remains a real threat. All ways die hard, and banks need to move to this open architecture to drive action around regulation, tax, and price. I guess the second point then is taking on an industrial approach, manufacturing. How do we change the nature then of what financial services has to become? The new metrics around funding are starting to drive the business model. They will highlight issues with the way banks have ended up structuring themselves to date. Even with the concept of a risk-free rate under pressure, it's counterintuitive that assets and liabilities can credibly be managed in isolation. For example, it'd be no surprise if we start to see some retail banks give branch managers, think about this, more mandate to create their own P&Ls rather than simply sales targets, which is what they have today. The shift in the organization will also drive changes in skills and capabilities. Sales and marketing is always important to an institution's success, but over the long term, it's more important to be selling the right things. Appreciating the fundamentals, banking ultimately comes down to risk in all its forms: credit, market liquidity, conduct of business, and this has previously been left to technical specialists, not people in the branches, not people in the front line. So you've had technical bureaucrats whose views were not often sought out or adhered to rush to meet the vision around how growth in sales per seller and products per customer is going to have an impact. Today, we see most of these changes coming in the cost-saving programs that we see. And initially, these will drive some changes, but they won't drive a sustainable effect. So ultimately, both the designers of the products and those that are selling it have to go through some changes to have a more detailed understanding of the long-term risk return of the things they produce and the quantity in which they're produced and sold. While to some extent it comes back to the performance metrics, it also means the type of people and skills you should see at the top of the business will change, requiring a significant cultural change as well as some operational transformation. I guess to make this change happen, the next thing is innovation and value, the future. So how will things change? As a result of the capability shift, innovation around products will be less about the novelty of the product, the complexity of it, how different it can be, and more on the fundamentals, such as matching durations across assets and liabilities, and more sophisticated risk pricing economics. And we're going to talk a little bit about that. It's back to basics economics. The waterbed approach, which has been a sort of a foundation of banking for some time, which basically says when we squeeze pricing in one area, we raise fees in another, and we keep squeezing here and there, and always finding something to counter each regulatory change. That's dead. Regulators have becoming increasingly adept at identifying those parts of the market where competition doesn't work effectively. Example, credit and debit interchange, OTC derivatives, etc. Regulatory arbitrage is not a sustainable strategy. You've seen from the recent Bank of America experience that, on debit card changes, that replacing fees from one part of the market where competition is not effective by raising fees in another area where it is, creates more serious volume and margin trade-offs for the banks than they actually had before. So banks are going to have to get more sophisticated and understand the likely response of different customer segments to price these increases. And they need to be matched with more technical appreciation of the fundamental values and risks that each customer and product survives. So it's ironic, though, that some of the measures that we put together to respond to regulation have involved, AML, anti-terrorism, FATCA, conduct of business, rules, and single customer view. These have been put in place to support regulation, but actually they form the foundation of data sets that are being developed which can be used to change the business itself. And I think we're going to talk a little bit about that later. So I guess the theme of analytics is one that I believe, and a number of my fellow panelists will pick up on, that analytics and data are actually an important key to the future. So in summary, When regulators are trying to redefine the purpose of your industry, as they are in financial services, you have to decide, are you in or are you out? If you're in, it will require profound change in the way that you deal with your wider stakeholders, how you structure your business internally, and how you think about innovation going forward. Thank you very much.